Hey guys, welcome back to my channel. For those who don't know me, my name is Jake and I'm active duty military. Recently, I've been making videos about the government TSP, and today we're going to cover the Lifecycle Funds. Okay, real quick, I got a disclaimer. You can pause the video and read this. I've been getting a lot of views on these videos, and I just want everyone to know you should definitely do your own research. Don't just take someone's advice on YouTube, but hear what I have to say and make your own decisions. Alright, for my last two videos I recently made, you can check those out. I go into more detail about what a trust investment is and what the 5 investment funds in the government TSP are. In addition, I covered why the G fund is performing so terrible and why you should not have money in the G fund long term. But in today's video, we're going to talk about the TSP Lifecycle Funds and why they are terrible. Currently, there are 5 Lifecycle Funds: 2050, 2040, 2030, 2020, and then L income. And we're just going to go through the pie charts real quick. For example, for L 2050, C fund is 42.76, G fund is 11.14, and basically the S, I, and C all shrink, the G gets much bigger, and the F basically stays the same. Big jump in 2020. All right, and then there's the final allocation when you get to L income. So what's happening here, it's called a glide path, where in 2050 you start off with 19% in bonds, 81% in stocks. Then you're slowly selling your stocks over time and buying more bonds until you get to the final distribution, L income, where you're 80% bonds and 20% stocks. Okay, now why is this bad? Reason number 1 is the Lifecycle Funds do not serve your specific needs. There's a lot of factors to consider when you're planning your retirement, such as the ability to deal with volatility in your portfolio, your income and growth needs, the value of assets outside your retirement account, the allocation of your investment accounts, tax minimization, and your time horizon, the time period over which you plan to invest for your retirement. The problem with these Lifecycle Funds is they're not tailored to you. It's a one-size-fits-all for all government employees investing in the government TSP. Another way to explain why this is unusual to invest in the Lifecycle Fund is, let's look at the L 2040. If you were to log on to the TSP website, go under My Account, Account Balance by Fund, if you chose 100% L 2040 for example, that is the same as deliberately choosing to be invested in the F fund, 7.56%, or the I fund, 25.11%. If you cannot explain to me why you want to be 7.56 in the F fund and 25.11% in the I fund, then you shouldn't be selecting the L 2040 fund. Now, I've already mentioned this in previous videos, but the government TSP website does a terrible job of explaining the funds to its investors. However, if you're going to be investing in this website, in these funds for over 30 years, you should take the time to really inform yourself of what the funds are, why you want to be in them, and then take your time, think about it, and then select the right allocation for your needs. Reason number 2 why the Lifecycle Funds are bad is you start money in the G fund and the F fund. And for me, this doesn't make any sense. When you select L 2050, you're not going to be retiring for another 30 years. It starts you off with 19% of your funds in bonds, 81% in stocks. And another way to look at this is this little pie chart, this wedge here, which accounts for 11.14% of your fund, is the same wedge over here. This 11.4% is the same 11.14% 20 years later. And as I'll show you, the G fund has been averaging 2.3% over the last 10 years. Over its life since inception, the last 31 years, it's averaged 5. But this wedge earning you 2.3% is the same over here at 2.3%. So for 20 years, you've not been making more than 2.3% on 11% of your retirement fund. And there's really no reason for that. When you have decades worth of time to invest, you should really be only in US stocks and equities until you get closer to your retirement. The reason why is because of number 3, inflation. Now, you might be thinking the G fund is a guarantee, I never lose money in the G fund. However, there are several years, in the last 10 years even, 2008, 2011, 2012, where inflation outpaced the returns you made in the G fund. So if you had any money in the G fund in 2008, 2011, and 2012, you net lost money when you account for inflation, the diminishing purchase power of your retirement. So once again, even if you're in the most aggressive life cycle fund, the 2050, you're starting out with this 11% wedge in the G fund, and it's just losing you money whenever inflation outpaces the G fund, which has happened 3 times in the last 10 years. Reason number 4 is the life cycle funds actually undercut your stock performance. And how to think about this is, let's look at the L2030 fund. Now, you're 32% in the C fund, and you're 33% in the G fund. However, the C fund, over its lifetime, has averaged over 10%, and the G fund is currently averaging 2.3%. Now, normally when you buy stocks or investments, you can reinvest the dividends, reinvest the growth. So when a stock performs very well, it just gets bigger. You get more shares, and it grows in your total value. But the life cycle funds don't allow this to happen. It's fixed your retirement at these percentages. So let's say the stock market is doing really good, the economy is growing, the C fund is booming, maybe it's averaging 20% this year. The C fund is never allowed to get bigger than this 32.22% allocation. So what's happening is that when the fund appreciates in value, it has to sell your shares. You're actually selling your C shares when the economy is doing well, and you're just buying more G fund shares. So the G fund is performing so terrible that in order to maintain its size, the C fund has to basically shrink, sell its shares in order to buy more G funds to keep these fixed percentages. Reason number 5 is the converse. You're actually selling stocks for a loss when in a recession. And this is one of the biggest problems with the life cycle fund, is it doesn't pay attention to what's happening with the economy, what's happening with the markets. It just does what it does. And what it does slowly over time is sell your stocks and then buy bonds. However, if let's say we're in a recession, the stock market's lost 30% of its value, you don't want to sell your shares at this point. In fact, you want to be doing the opposite. You want to be moving from bonds to equities, and you want to be buying more stocks at a discount now that the price is down. And I talked about this in my other video. The stock market always comes back. You only lose money when you sell your shares for a loss. When the C fund is down in share price, as long as you don't sell your shares, you haven't lost anything yet. You just have to give time for the market to recover, and then you won't lose anything. However, the life cycle fund is selling your shares at a loss to move from stocks to bonds over time, regardless of what's happening in the market. Okay, there's a really nice website called tspdatacenter.com. It shows the fund performances going all the way back to 1988. The S and the I funds were introduced in 2001, and the life cycle funds were introduced in 2006. The L2050 fund only goes back to 2012, but we have fund performance data on the L2040 life cycle fund going all the way back to 2006. So what we're going to do is we're going to do an example of how would your fund have performed. Let's say you were a government employee who left government service on New Year's Eve 2005, December 31st, and then you had $100,000 in your government TSP. Now, how much would you have at the end of 2018 if you began with $100,000 on January 1st, 2006, and once again, you've left government service, so you're no longer contributing to the fund. You're just relying on the fund performances to grow your retirement account. If you were in the L2040, at the end of 2018, you'd have about $218,000. It almost doubled over that time period. Now, for comparison, if you were in the G fund, you would have about $143,000 by the end of 2018. And if you were in the F fund, you'd be at $169,000. The F fund, in my opinion, is really underrated. It's only had actually 3 negative years in its 31 history. So yeah, the G fund never has a negative year, but the F fund performs just a little bit better, and there's almost no risk. If you wanted to hold bonds long term, I would recommend the F fund over the G fund. All right, now we're going to compare the Lifecycle L2040 fund to stocks. The S fund is small cap stocks, and the C fund is the S&P 500 fund. Once again, beginning with $100,000 on January 1st, 2006, by the end of 2018, if you were in the S fund, you'd have $270,000. If you were in the C fund, you would have $265,000. So compare that $270 that you would have made in the S fund to the $143 you'd make in the G fund. Averaging those two together is what gives you the L2040 fund. You know, it's somewhere in the middle because you're investing in both, but there's really no need to. So here's the 10-year performance of the S and the C funds. They're both over 13%. It's been overperforming because the economy's been really good the last 10 years. However, the C fund over the last 31 years has averaged 10%. My advice to you is if you're under 55, you should only be in stocks. You should only be in the S fund, C fund, or even the I fund. And then once you're over 55, then you can start thinking, I like where my retirement account balance is at currently. If you're happy with the size of your retirement account, then go ahead and start moving it to bonds in order to protect it from a recession. And once again, that's only if at age 60 you plan on starting to withdraw the money. Because when you start withdrawing from your TSP, you're selling shares that you'll never get back. So the question you have to be asking yourself is, why do the Lifecycle Funds exist? And actually, very soon they're adding 5 more. Why is the government pushing this on people and recommending them? Reason number 1 is it is better than the G fund, and the G fund for the longest time was the default fund. However, that's thankfully been changed. The default is now the year-appropriate Lifecycle Fund. It's not a great reason, but the Lifecycle Funds are better than the G fund. Reason number 2 is it's a no-fee management beyond the basic funds. Obviously, you're invested in all 5 of the basic funds. You're still paying a management or service fee. However, the Lifecycle Funds kind of is some form of management that you don't have to pay for. It's a free service. And I think people like that idea. Reason number 3 is it requires no knowledge of the TSP. If you just say, I'm retiring in 2050, I'm going to put it in the L2050 fund, then you don't need to know what the I fund is or the F fund is. Once again, I don't think that's a good reason, but I definitely think that's a contributing factor why the Lifecycle Funds exist. Reason number 4 is people don't like seeing loss. You know, when your account goes up year to year, you don't question it. You know, why is it going up 30%? However, if you have a negative year and it goes down just 5, you freak out. And you see short-term loss as a bigger concern for you than long-term gains. However, I've been thinking hard about this and I think I know the real reason. And the real reason is that people are terrible at timing the market. And the government wants to protect people from poor rebalancing decisions when the market goes down. And we can talk about the TSP performances in 2000, 2001, and 2002. That was a bad year for the stock, or bad 3 years for the stock market. This was the dot-com crash after the 90s. This was the September 11th attacks. This was the lead up to the Iraq War. And US stocks just got hammered these 3 years. And when people see their fund performance going down, what do? They sell at a loss, which is the exact opposite thing you want to do. And then look at 2003. The C fund was up 28%. Well, people see the stock market is going up again. They then move back to stocks. However, it's too late. They've already gone up. You should have bought when they were down and sold when they were up. But people can't time the market. They make decisions based on emotion, and they're too reactive. They're not planning long term. Okay guys, thanks for watching. If you enjoyed this video, please give me a thumbs up so the YouTube algorithm will recommend this video to other people. In addition, if you haven't already, consider subscribing to my channel. I post weekly about military and finance topics. And if you have any ideas or comments, please leave me one down below. I love hearing from you guys and I will respond. Until the next video, take care.